Thank you all for joining us. Chris, first of all, the uncertainty, I don't know whether that means that you need to be a little bit more careful on what's happening, given interest rates, the fact that we were expecting so much from the Fed and then that got pulled back, geopolitical uncertainty, or whether this is a good time for deals.
Francine, thank you for the question. Thank you for having us. I think when you look at the dynamic, the opportunity is extraordinary. The opportunity is extraordinary. General Atlantic has been investing in the emerging markets for over 25 years. And when we take a step back and we look at the forces that are affecting the world today, you think of digitization, you think of healthcare innovation, you think of climate transition. These are forces that know no borders. But also what knows no borders is entrepreneurialism. And when we look at the emerging markets, we see 85% of the world's population, 40% of the GDP. We see customers, consumers, creators. And so when we look at the landscape, what we see is incredible opportunity, vibrancy, entrepreneurialism is alive and well. And in part, I say that, Francine, because the raw conditions, the ingredients for success, which we have seen before in the United States, in Latin America, in Asia, we see them here as well. Education, healthcare, infrastructure, both digital and physical, supportive government policies, and as your last conversation talked about, capital markets. So all of these things, in our view, combine to make the opportunity extraordinary.
Rahul?
I totally endorse what Chris says. The opportunity, to my mind, is humongous at this point in time. When you look broadly across emerging markets, and I don't want to sort of rattle off the 11 countries that make up the emerging markets, but just staying with a few, India, significant opportunity, whether it is to do with the demographics, whether it is to do with the digitization that's taking place, whether it is to do with just the growth that you're seeing across sectors is just, coming in to fruition right now and for many, many more years to follow. The second is really when you start to look at Brazil. That too is another significant opportunity, but the one that I really want to spend time on is GCC. And this is my first trip to Qatar after 24 years. And it's really amazing to see as to what's happening on the ground. I live in Dubai. I see what's happening in Dubai. In just the last 3 years in Dubai, and you spoke about the capital markets, 10 billion worth of IPOs that have been raised just in the last 3 years, which you haven't seen in developed markets of that same magnitude. So you start to sort of put this together, and that's where you start to zero down. So I think clearly this is the next decade is for emerging markets.
Matteo, how does it feel being in the region?
Well, I've been here for 8 years and I'm very happy of my choice. In QNB, our expertise is more on liquid markets, so I cannot pass judgment on the interview that you had before on illiquid strategies. And I would like our audience to take away at least one message about delivering alpha in emerging markets today, and specifically for fixed income securities. There is opportunity because the region pays a lot more, a generous spread over the treasuries. So there is a new asset class that was not available a couple of years ago. Cash is no longer trash. Short-term MENA dollar bonds represent value. So this is the first takeaway that I would like our guests to consider. I'm not so convinced, generally speaking, because I face clients that emerging markets equities should be all put together in a blob. This kind of benchmark can be detrimental to delivering alpha.
Yeah.
I used some Bloomberg indexes before coming here.
Always, I hope.
Of course. During the last 10 years, the world grew by close to 10% in dollar terms. Emerging market equities, believe it or not, 3.7. So I hope you are right in projecting that the emerging markets are the next decade. as a blob, but you have a lot of catch-up doing. Internally, as QNB, we are more focused on single countries. So we are going this way, instead of suggesting a general exposure to emerging countries. We like the individual approach.
It's an
Can I-
interesting
sorry,
panel
can I make it a
because, yes, go ahead.
Sorry to interrupt, but just, I sort of hear what you're saying. When you start to look at the equity space, it's not a broad brush that you go and invest. You got to choose the geography, i.e. which market. You got to choose the sector that you'd like to really be in. And then you got to really choose the counter or the company that you'd like to invest in. So yes, it's not that broad brush, I'll just go and pick up an ETF in the US or in the US, but I would do this selectively. So I agree with you, but in essence, you got to really look and see where that opportunity is, and that's the emerging markets equity story. Sorry.
But it's
to
interesting. I
interrupt.
mean, you look at equities, you're running a business, you're looking at capital, you're looking for capital. It's interesting, is there a dollar problem, actually? Does it also go back to the Fed and the stories of these emerging markets will change over the next couple of years because of what happens with the Fed and politics, Chris?
Well, I don't know if I can comment on politics or the Fed policy, but I will, though, agree with what you're saying, though, is that we're talking about alpha, and we're not talking about beta. And the dispersion of outcomes is surely widening because of those things, the geopolitics, and because of rapid changes to monetary policy. But when we look at that dispersion, certainly in the private markets, the focus for all of us as investors in the private markets has to be on identifying the top managers. Because most of us in the private markets are not investing directly in entrepreneurs. Most of the limited partner community is doing so through the general partners that they select. So then the question becomes, which general partners are in a position to actually achieve that outperformance? Because I agree with you, it only makes sense to participate in this asset class and perhaps in the region if you are identifying those top performers. And my view on this is the world has changed because of those things that you just mentioned. There was a time of easy money where there was a rising tide, lifting all boats. You did not need to spend you could have been in a canoe and it would have been just fine. And there was wind that was carrying you forward. But today, the water is choppy. There is no wind. You have to create your own wind. And so the things that we have to do as general partners to succeed are different than what they have been in the past. I would give you three things. One, in the emerging markets. One, you need to be local. And I don't mean local presence, I mean local residence. Tourists come in the summer and they leave in the winter. You need to be here day in and day out. You need to be truly local. Number two, you need to have global expertise where you have the pattern recognition of other regions, where you deliver value creation to those entrepreneurs. And then last, you need to have thoughtful risk management and alignment. You have to, in our case, we have a global program, a global fund. And so in the days where it's not sensible or it's not attractive to invest, we do not feel compelled to do so. So you never want to find yourself being a hammer looking for a nail.
So the question was more around inflation and the impact that it has to emerging markets.
And then I'll ask about expansion plans like I will to Chris in the region.
Okay, great. So on the inflation front, yes, clearly that is top of mind for most investors, whether those that are investing in emerging markets or those that are investing globally. And yes, today fixed income, cash, near cash, gives you equity-like returns, so people are happy staying invested in that at this point in time. So what you've seen in emerging market economies is that they haven't really reduced the rates where they needed to make sure that the FX or the currency is not that severely depreciating, and that's been sort of the story as far as inflation is concerned. And I agree, you have to, at this point in time, be extremely selective. You've got to choose the right managers as to how you want to play the opportunity across each and every of these markets.
Matteo, how do you see volatility in all the markets actually that you're invested in?
Well, the VIX is very low, around 12. And
That's surprising, isn't it?
It is surprising. Everything is gummed up. Valuation is very rich in US. Geopolitical risk. Okay, Taiwan, the last 10 years, 13% in dollar terms. So pricing or hedging this kind of risk is impossible. How much gold can you put into a portfolio hoping for a disaster? Now, volatility, our style of investing, once you have a plan, when you take a strategic allocation, you should be going on holiday. You should be not micromanaging your position each day. Otherwise, your broker will be very happy, but perhaps your client will not.
So what's, but longer term, so what's your best, I mean, again, countries, if you break it down, are there countries longer term that you can be, you know, confident? Are we retracing basically trade between countries? That means that one emerging market will come up trumps compared to another.
Well, it is very difficult to pass judgment, but if you strip away China from the emerging market blob, the performance is materially different. And China was one of our best peak until it wasn't in 2021. So not all emerging markets are investable, even if they are growing, even if there is commitment and young population. So before you bet against the dollar, before you diversify away from US, think twice.
Word of warning. I feel like we should all be silent because it is. I mean, it is something that you think about. Chris, talk to me a little bit about actually expansion in the region. Are you going to independently grow in the Gulf?
I mean, we've been active in the Gulf for over a decade, investing, and General Atlantic is going to be opening offices in the region. And I'd say that because we're long-term investors. In the private markets, all of us are long-term investors. And just to reflect on your great comment about the changes, you know, it's been said that we tend to overstate the changes in the near term, but we underestimate the changes in the long term. And when you think about these long-term forces that are affecting the world, the region certainly, you know, we just see great opportunity there. And you know, we see it from the perspective of capital formation, in terms of clients in the region that want to invest globally, and we see it in terms of opportunities to invest in the region as well. And many of these journeys have happened before in other regions. Some of our most successful investments have been in Latin America, for example, and have been in China, and we can see many parallels to what is happening throughout the region. Now, I think, of course, it's overgeneralizing when we talk about the emerging markets or the developing markets. These are gross generalizations. Every country is specific. Every economy is specific. And we see opportunities differently in each one. But in this region particularly, we are absolutely growing in this area.
Is there something that you have in mind as some of the things that we should be watching out for in specific countries?
Well,
over the next couple of years?
I think certainly in Qatar, in Saudi, in the UAE, we are seeing government policies that are incredibly supportive, political dynamics that are very stable, and capital market formation, as you said earlier, that is incredibly encouraging. And so I think in all of these areas, Francine, our firm certainly will be expanding.
And more than 40%, right, of your portfolio is currently in emerging markets.
Yes, thank you. More than 40% of our portfolio, we've invested $22 billion since inception in the emerging markets. That's across 146 companies, and today over 40% of our portfolio is in the emerging markets.
Rahul, how will you expand, actually, Julius Baer, in emerging markets?
So let me look at and break that up and first focus on this region. So we've been in Bahrain now for the last 50 years. We've been in Dubai. We were licensed #1 at the DIFC. We celebrate 20 years in Dubai this year. In Qatar, over here, we opened our office in 22. So 2 years in over here. That really is our presence in GCC. And we've been covering this region from Switzerland, from the UK, and from Dubai within GCC. So we have been over here, like I said, 50 years, just within the region. When we start to look outside and we look to India, that is a big focus market, a big growth market for us. We are the #1 foreign private bank in India. We're investing significantly in India, whether it's people, product, platform, distribution. As you see the wealth creation that's taking place, we are now in 7 cities on the ground in India. So that's a big focus in for us. And when I look at the broader emerging markets region for Julius Baer, it is roughly a third of the AUM that we have. So we are really big believers in the story with the wealth creation that's taking place, with the migration that's coming in over here to these parts, where we believe that we need to be where the customer is. We need to be a lot more local. And I think Chris said that. Gone were the days that you could sit in one part of the world and cover the region broadly. You need to be on the ground. You need to be physically there. You need to be closer to your customer. That's where you'll get a good feel and pulse about where the opportunities are. I'll just say one other thing. In the past, people that lived in this part of the world or lived in emerging markets predominantly invested in the Western world or in developed markets. That is now significantly changing. People are looking for opportunities within emerging markets. And I'm using the word emerging markets very broadly, but what I said earlier in terms of the different countries, but that is where you're seeing the shift now take place. Not a plug for Julius Baer. We just put on an India fund on our platform late last year, already raised 300 million across the entire bank. So just goes to show that people are waiting and wanting to invest in these countries, and people that live here want to invest here.
Rahul, I don't want to oversimplify, but there have been a lot of parallels on India being what China was maybe 30 years ago with the same kind of growth trend. Is that right? Are we overestimating? Are we underestimating that kind of growth plan?
No, I think you've got to look at India as an India story, China as a separate story. It's not because of what's happening in China that people are looking and saying, okay, now it's India's time in the sun, and this is the time that you would like to sort of invest in India. Any emerging market or any country, including India, has its set of challenges, which is where you need to be extremely specific in the sectors that you want to invest in the companies that you want to invest in, and you don't have to pick and choose individual equities or stocks to be able to do this. And you've got to be able to choose the right managers who are going to do this in and for you. The evolution that India is going through is, yes, I wouldn't say 3 decades. I would say it's easily 5-10 years behind where China is. India is sort of 5 trillion, getting to 5 trillion. China's already 17 trillion. So there is that gap. But just from an opportunity standpoint, I would strip that and look at them as 2 separate markets per se.
Matteo, you seem to have a lot of question marks about some of the emerging markets, certainly about equities.
Yes,
do
I
you
do.
think that was pretty clear. Does U.S. exceptionalism, or does this U.S. growth story continue?
It doesn't have to do with the growth of the economy. It has to do with the system that rewards shareholders. You can grow an economy and still have underperforming stock exchanges. In the short term, the corporate performance and the stock, they are not correlated. But in the long term, they should be. And they are, particularly on US. Elsewhere, this correlation breaks down. You can have the growth in the economy, the stock doesn't move. So there are these powerful forces. India is the best example. And in some jurisdiction, this will become performance for the investor. But that is very important to us. So coming back to the dollar, is there a dollar problem? Potentially, yes. Inflation is sticky, is going to remain 5%, and people get used to these numbers. 5% dollar interest rates eventually will become perhaps the norm. Try to beat a 5 in dollar is not easy. It's not easy. 5 will represent the comfort zone for many investors. And I go back to my original statement. For the emerging market, fixed income, the region is the sweet spot.
But at some, and again, at some point, so how do you explain, if you look at the mismatch, I guess, between growth and stock valuation, is it cutting red tape? Like at what point do valuations go up, right, for stocks to kind of
Perhaps
reflect the growth?
Perhaps they don't. There is no material need for a stock to go up even if the economy is growing. Stock go up when they pay more dividend, when there is buyback, when you can remove the people in charge if they're not performing. You have to have these three things. At that point, the performance of the economy on the aggregate becomes the performance of the stock.
Chris, talk to me a little bit about this idea of growth relative to valuation, because I guess you can find deals or sweet spots in places where you see valuation a little bit low, but actually with the real potential to grow.
Well, look, there's an absolute dislocation happening now if you think about the supply of capital and the demand for that capital in the private markets. So the demand for capital from businesses, the IPO market has been closed or has not been as open for now 2.5 years. The GPs, the managers, are having trouble fundraising in general around the world. And so you have companies now that need funding, but at the same time the supply of capital has not been there. And so there's definitely a mismatch. We see companies today in our pipeline, 30-40% growth revenue growers that are at half the valuation that we would have seen 2 years ago, and a third the valuation 4 years ago. So there's absolutely a moment right now. It was easier to do this 5 years ago, but today we are definitely seeing a dislocation. But I'll also comment on the opportunity and bringing it back to the region. I think people need to experience what is happening here in order to truly understand it. And if I look back to the first time that I came here over 20 years ago, and if a time traveler came back and visited the younger version of me back then, the time traveler would have said, okay, in the future, we're going to see the internet, mobile, cloud computing, the genome mapped, and all of this development. And when the time traveler visits us in general, we say, oh, I can't believe this is going to happen. But now I ask myself, what if the time traveler comes from the year 2030 or 2031, 2032, and what does he or she say? They are going to be talking about a resilience and a dynamicism and a growth that we see here. They're going to be talking about that. And so, yes, there's a near-term dislocation, and it's very interesting, but we are most excited about the long-term trajectory.
Where do you see the biggest, I guess, capital, dislocation?
So I'll go back to the growth and the valuation question that you asked. I mean, to my mind, was the valuation 2 years or 3 years ago highly overvalued? Is today the right valuation? The question is around where is the baseline and what should that baseline be? And it all then comes down to you can't have a broad brush approach, especially when you're looking at emerging markets. Is fixed income a great opportunity? Slam dunk it is. But within that, within the equity space, I think on the valuations, when you look at it, it needs to be very, very specific rather than a broad brush. A broad brush doesn't really sort of work here.
Hey, to all of you, because we're almost out of time, what's your best risk management tool? Do you go to how much cash do you have in your portfolios, Matteo?
A lot. A lot. We allocate.
What's a lot?
A lot is double digit, and we are very happy. We avoided all the downs in some countries, and it makes sense to us to tell the clients that we avoid a huge drawdown, and we did.
Chris, where do you see as protection?
I think the most important thing is to have agility, is to have control, to not be forced to do something because your fund document compels that you make investments when you shouldn't. You need to have the agility to be able to say no, so that you are then enabled to be able to say yes.
Rahul?
Just stay invested. That's what you need to do at this point in time. There's significant opportunities. people come in and get out of the markets at the wrong time. As a wealth manager, I would say stay invested for the long term.
I feel like this is a whole other panel. Thank you so much for making it pretty lively. Thank you.